Another edition of our IndexMore webinar series, where we aim to bring you unique insights into the inner workings of index building blocks. My name is Nico Katzke, Head of Portfolio Solutions at Satrix, and I will be moderating today's very interesting session, where we explore European and Japanese investment opportunities while also unpacking what transpired in Davos. Now, at Satrix, we recently announced the addition of two new ETFs that we are bringing to market. The Europe Stoxx 600 and MSCI Japan feeder ETFs. And the purpose of today's session is to provide you a deeper look into the investment opportunities and crucially too, the diversification potential provided by both these investment vehicles. Now, the backdrop for today's session can be characterized in various ways. Firstly, the world is changing and fast. New alliances are forming and old established ones are being challenged unceremoniously. Secondly, markets have been selling off sharply across the board. Many of the darling trades of 2025 have in recent times come crashing down, with technology and software companies, precious metals, private credit, and digital assets all seeing quite a fair decline in recent days. Now, the US yield curve is steepening, and Japan's bond market has been selling off sharply too. So a lot is happening on markets. Now, today, investors are left unsure on whether to brace for a second round of sell-offs or whether the big rebound is about to happen again. Now, we have today a series of contradicting data points for developed markets. Firstly, sentiment measures indicate great uncertainty around fiscal sustainability and developed market governments' ability to service growing debt levels in the face of aging populations. Now, this has created an insatiable appetite for real assets, such as gold, as we saw in 2025. However, macroeconomic data around inflation and job numbers seem to suggest that things are okay and that this uncertainty is misplaced. The markets have, unsurprisingly, been quite erratic in squaring these opposing sets of information of late. Now, add to all of this the recent World Economic Conference at Davos that recently completed. And from the outside, it seemed like a tense conference. Amongst many interesting snippets, the Prime Minister of Canada, Mark Carney, and German Chancellor Friedrich Merz stood out for making astonishing claims around a decline in trust in US cooperation and shared values around free trade and defense. Ken Griffin, famed US hedge fund manager, likewise made statements around policy uncertainty and the impact this will have on businesses' ability to make long-term predictions. In particular, he noted that no one today is confident around what US tariff policies will look like in 4 years or even 2 years, and whether a post-Trumpian US policy agenda might revert back to a more market-friendly free trade and NATO alliance-centered framework or not. Now, this uncertainty means that firms looking to invest hundreds of millions of dollars in developing their manufacturing capabilities may actually take pause or start to price in the high cost of uncertainty. The effects of this may take years to materialize, but his point around it inevitably affecting producer costs and ultimately consumers cannot be ignored. Add to this as well uncertainty around AI's adoption, and you are left with companies facing lots of uncertainty when making long-term business decisions. Now, all of this directly affects job creation capacity, price stability, and further stresses the already fragile trade alliances that we have today. Now more than ever before, we are reminded that global trade and macroeconomic cooperation does not exist in a vacuum and is certainly not to be taken for granted. Now, to unpack all of this today and discuss also our new ETFs and the important role that they can play, diversification role that they can play in your portfolio, we are joined firstly by Annalisa Usardi, who is the head of advanced economy modeling at Amundi, and she is going to set the scene by providing a macroeconomic overview. Next, we have Michael Stewart, head of equities business strategy at Amundi, and he will be providing more insight into European and Japanese stock markets more specifically. And then finally, we are joined by a man that has been known to frequently light up the Twitter space. He is Siyabulela Nomoy, quantitative portfolio manager at Satrix. Now, a warm welcome to all of you, and thank you for your time. Now, Annalisa, if we can perhaps start with you. I just mentioned that the tense nature of the Davos conference and how European countries, for arguably the first time, collectively stood up to Trump and US policies. Now, from the outside, it seems as though there's a structural regime shift underway in Europe. Now, what's your main takeaways from Davos this year, and what lessons have you learned?
Hi, thank you, first of all, for having me today. As you said at the beginning, the Davos conference was tense outside, seen from the outside, but was tense also on the inside, as we had several representatives of our company there. So fundamentally, they were saying that the takeaways from the event and the speeches on the one end, and on the other end, on the mood around of people was, of course, that there was a sort of a coordinated effort in trying to stood up against the unilateralism of the US in some way that have been in the last year imposing a lot of tariffs, announcing tariffs, and in sort of jeopardizing the old equilibrium at global level. So the reality is that, in our opinion, we are now transitioning towards a world in which equilibrium is reallocating, is trying to find itself in new ways, and more importantly, is multilateralism the world that we are going to see. So and to see imposed by these new alliances. In this context, what is important is no longer we have big powers, but also middle powers. They have to, in some way, find new alliances, and Europe is one of them. So importantly, what we are learning is that Europe is increasingly becoming aware of the fact that Europe needs to be, first of all, strengthening the domestic relationship, strengthening inside, and in particular, we see it through, the strategic autonomy plans that they are implementing on the one end, and on the other end, they have to strengthen their international relationship. And if you want some examples of this, the recent announcement, for instance, with the European and India trade deal of the Mercosur are actually going in this line and in this direction. So we are seeing Europe moving in trying to strengthening both its role together with other countries and powers on the one end, and also strengthening domestically. What is important to me to stress in this environment, in this scenario, is that we have material evidence of this is happening. It is starting from 2021, 2022 with the Next Generation EU plan that is 750 billion, so almost 6% of 2021 GDP. So a huge effort in trying to stabilize and to make stronger the domestic economy, see the economic performance of Italy or Spain or even Greece on the one hand, and on the other hand we have a lot of efforts from the European authorities in pushing for more strategic autonomy on the food, on the energy side, on the defense side. And for instance, again, just to go for concrete examples, the 100 billion plans for Germany that is pushing on strengthening defense is going in that direction.
And tell me, Elisa, is closer cooperation amongst the diverse set of countries in Europe at all realistic? And might we look back in a few years at this year being a turning point for closer co-integration?
Yeah, I would say so. Every time there is an old say that every time there is a crisis, Europe gets together and improves and finalizes something that maybe was difficult to reach before. So that's the case of the Next Generation EU plan after the COVID crisis. And we think that there is a sense of urgency among European policymakers to get together and have more action. And I think that one of the most important points on Europe is that we are going to see fiscal implemented, so fiscal push implemented where there is fiscal room indeed. So Germany is the first case, but there is also additional fiscal room allocated and granted by the European Commission for countries that are willing to spend more on infrastructure and in particular on defense. So we are seeing action by the European Commission in this direction, and this has important, if you want, real implication in the real economy and also on the investment side, because all this push on the fiscal side, on infrastructure, on investment, on strategic autonomy, on green energy is going to materialize in more investments at the public and private sector, and is going to translate into a strong demand for these sectors. So, of course, this is something that has important real economy implications, so in terms of higher growth on the one hand, and also investment implication if you want to bet on this change.
Now, Michael, if I can bring you in next, if we can drill down a bit further into specifics, what is the investment case currently for Europe? Are you more optimistic around European equities today than before? And if so, have you made changes to your asset allocation views in following recent events?
Yeah, well, thanks, Nico. Again, thanks for having us here on this webinar. And I think to answer that question, very briefly, the reality is we have seen investors from all types increasing their allocation to European equities. I think as a key stat, 2025 was the biggest year on record for flows into European equities amongst the UCITS ETF market. So just to confirm, that's kind of the international ETF market, and over 60 billion euros of flows last year. And that's a remarkable figure, Nico. I think it just shows the way that Europe is redefining its place in global portfolios. And to be clear, 2026 has started in the very same way. We've seen already, just now we're in early February, we're talking about over 10 billion euros already into European equities. That's 2 times the level that we've seen go into US equities over the same period. So very much, I think, asset allocation decisions have changed, and those changes are coming through as we see the flows from last year and into this year. And ultimately, there are a few reasons for this, of course, right? I think clearly we talk to our investors about diversification, but I think it's actually more of a pull factor bringing investors to Europe, not just a push away from other markets. And that's an important point to really highlight. And I think there are a few key reasons around this. And perhaps the first, maybe the most straightforward, is clearly the valuation landscape between Europe and the US. I think broadly, European equities trading around 16 times forward earnings, which is the earnings over the next 12 months. That is typically seen as a very unchallenging level compared to the higher valuations that we see out of the US. So ultimately, there is this valuation story for Europe. There's a dividend yield story, dividend yield around 2.8%, clearly well above what investors are seeing from the S&P 500. So that's maybe a nice starting point. But I think still, you need those catalysts, ultimately those reasons to be excited about investing in Europe, ultimately about seeing opportunity in Europe. And a few of these have been mentioned by Annalisa as well, but maybe just to highlight 2 key sectors which we feel are really driving a lot of the interest in European equities in 2026, and really have been, I think, for the end of 2025 as well. Now, the first of these is financials. European financials, which may not always be the most exciting sector to hear about for investors, has actually been where the action has been for the last, I would say, at least 6 months to a year, and continues to be the case. European banks are in a very strong space when it comes to their stability. When we look at things like the capital ratios, the buffers that these banks have on their balance sheets to protect from periods of stress, we're seeing very strong levels across the landscape in European banks. So the stability is one aspect. Again, the valuations will be a second. So talking about the market valuations first, now focusing just on financials, we're seeing valuations of around 13, 14 times forward earnings, which is still below the market more broadly, and there is opportunities for that to potentially increase as we do see strong return on equity, strong net interest margin. These are key stats, key factors that the market looks for when thinking about revaluating or repricing these shares. I think those are clearly 2 levels, but ultimately the last one that I wanted to highlight for financials, which I think is also perhaps maybe less understood, is the ability that financials have to actually participate in a rising environment of economic growth. Though Annalisa mentioned already the German fiscal stimulus, which is clearly a huge story in Europe. I mean, it really is the powerhouse of Europe, really deploying funds at scale for the first time that we've seen in quite a long time. And banks are actually well positioned to participate in rising growth, rising metrics such as GDP, or even these kind of more forward-looking metrics such as purchasing manager indices, PMIs, we often refer to them as, we do start to see these numbers increase. Banks tend to do well in this environment. And ultimately, these reasons together ultimately have made quite a kind of positive environment, I would say, for European banks, European financials, and this continues to be one of those key areas that's driving interest, that's driving investment into the region. And from a broad indice perspective, of course, it is the largest sector in the index. So obviously it's something that investors are getting good exposure to, even on a broad exposure, which I think is important. Now, the second one, which I think is incredibly important, is industrials and defense, right? Defense here is clearly a subset of industrials. Now, this is one that perhaps needs no introduction, but when you look back at 2025, think about all of the announcements, really the tsunami of spending announcements that we saw from European and NATO governments last year, whether it's 3.5% of GDP is the new NATO target, 5% in many cases when you combine infrastructure spending. This is clearly a step change in spending for European defense. And that's not the only factor, though. I think that is clearly a headline factor that many investors will look to. I think there are actually two other areas within defense that are potentially quite interesting and have the potential to drive that growth going forward. And the first is ultimately the percent of capture, so spending capture, that actually falls to European contractors. I think actually if you look back a few years, this is quite interesting because if you look back a few years, the majority, so 60% of the defense spending in Europe was going elsewhere, was going to either the US or other markets because the domestic capacity just wasn't there. Now, today, that has flipped, and we're seeing more and more of that spending actually flow to these European contractors who have therefore been able to scale up, to actually have a bit of M&A activity, increase their size, increase their capacity, and compete for more and more of that spending, but also for export markets, for spending outside of Europe too. So this is a really positive story for European defense contractors thinking about the ability to compete for spending globally and not just within Europe. And these are a couple of catalysts that we see within the European defense space. And finally, if I were to broaden that out a bit more to the broader industrials, no surprise that infrastructure investment, grid investment, thinking about the electrification of the economy and what needs to be spent when it comes to renewables, when it comes to powering AI data centers, this is a huge area of growth as well. And there are some global champions within Europe that participate clearly within this market, but also much more broadly too. I'm thinking about names like Siemens or Schneider Electric, who are two examples of these global champions in the infrastructure investment space that are based in Europe, that have their markets here, but clearly also export around the world. So these are kind of the two main areas that we're seeing a lot of interest in that, again, are driving some of that excitement, some of that interest into broader European equities.
Michael, I must say, at the risk of sounding like flattery, that's been the most concise and one of the best investment cases for Europe that I've heard in a long time. We keep hearing about the debasement trade, that there's the push factor, like you mentioned. People just want to diversify away from the US, but what you're speaking to is a clear pull factor, right? That there's industries in Europe that is kind of awakening to a new market, new sort of fervor in Europe, especially looking to actively diversify away from US dependence in a lot of these sectors, and of course banking and financials, which is Europe has been famous for. So it's not just luxury retailers, and I think that's kind of the problem that we have sitting outside of Europe, just viewing it from an investment perspective. We oftentimes hear the same narrative. It's just a temporary debasement trade. But what you're saying is there's more fundamental value in Europe that is waiting to be unlocked. So thank you for that. That's a very interesting perspective. Unfortunately, we're going to have to turn to currencies as well. So the dollar has been on the back foot since Trump took office, and the one undeniable check on his executive powers have not been the co-equal branches of power on Capitol Hill, but instead it's been the bond market. Now, bonds are famously far less likely to bend to Trump's will. Now, maybe Annalisa, if I can ask this question to you, do you see euro strength versus the dollar continuing through the remainder of the year? And do you possibly foresee bond markets further forcing Trump's hand on negotiating more favorably with Europe for the remainder of this year? Very hard question, but I don't know if you have some interesting perspectives for us there.
Yeah, on the dollar and the euro, the answer is yes. We keep seeing, a weakening, or at least a weaker dollar overall. we have a sort of corridor 119, 122. So that's the corridor we are now considering for this pair. Of course, here the point is that what we have seen last year in terms of performance of the dollar, that was totally unexpected in this environment of uncertainty on the trade front, has been the reflection of investors diversifying away from dollar assets and moving with their investments in Europe, as we have seen, to emerging markets and other global allocation. So this is something that we think is going to continue, and the reason is because, of course, now the concern is about the trust. It was mentioned also in Davos, and not only in Davos, but the trust in the US, in the US policymakers, and in general the reliability of trade agreements, as we know, that can change very, very, very quickly out of a tweet. So, of course, this is something that is, in our opinion, going to last and remain there. And of course, this is also linked to what is happening on the other point that you were making at the beginning related to the debt sustainability concerns and the fact that in any case yields have been moving higher, not only for the US but across the globe toward and with a higher risk premium. So here the point is that in our opinion the US will face on average higher yields, especially on the long end, because of fiscal concerns, and especially so if the Supreme Court is going to rule against the tariffs that were implemented so far and that were in some way helping a bit in containing the deficit. They were not the main point of containing or stabilizing the debt trajectory for the US, but of course that would be another point against the concerns around the fiscal stability and the fiscal discipline in the US. So of course, let's say this is going to align with a weaker dollar for the year.
Just to put it in perspective for our listeners, a year ago the dollar was $1.03 to the euro. It's now 1.19. That's incredible movement, right? That's not sort of minor adjustments. If you think of the rand going from 3 rand to 19 rand to the euro, I mean these are very big moves. And Lisa, if we can turn next to Japan. Now, some analysts have likened this Japan to Asia's sleeping giant, right? Seemingly now emerging from a decades-long economic hibernation, albeit for now still occupying the spot as the second largest developed economy by stock market capitalization. So I always find it fascinating that we talk about, Japan's sort of sluggish growth, but it's still one of the biggest economies. Can you paint us a picture of the structural and economic challenges Japan faced since the mid-90s, and why investors are starting to believe that today things are changing for the positive?
Yeah, let's say on the Japan story is the so-called lost decade, right? After the market collapse they had and experienced on the asset and also on the real estate in the 90s, the government tried to support the economy with the fiscal, monetary policy support, but still this was difficult to change, and actually Japan lived a decade of stagnation and very low, if not negative, inflation, and that was rooted in an issue that is a structural one, that is a demographic issue with a population that is getting older, labor force that is shrinking, and debt that is increasing for higher spending on the fiscal side. So this is something that, of course, has been a structural force that has been driving the dynamics in Japan and the inflation in Japan for a long time. Just to give an example, even growth was below 1% on average for more than a decade, and in 2002. And then since the last few years, I would say 38 months, if you want, we had something completely different. The average inflation was much higher than even the target, actually averaged 3.5 to 3.8%. Growth was positive, but this is because we have been seeing in Japan following the so-called Abenomics, and now with the latest election results and even yesterday election results, a further push on structural transformation in Japan that is, in our opinion, pointed to a clear change in the structural dynamics of the Japanese economy. In particular, what is important to us is, again, seeing inflation that moves higher. And this is not because the demographic issue is no longer there, it's still there, but because of the structural reforms that help, for instance, to have higher mobility between workers. So also higher wage growth dynamics that translated into higher inflation and higher consumption. And also all the fiscal push and the structural changes that we have seen on the corporate side, on the industrial side. Also thanks to the latest election results from yesterday, most likely are going to be continued in the future. And this is going to sustain, again, the idea of having a structural change, more corporate dynamics, more investments into Japan, that is going, of course, to attract, if you want, the interest of investors that are going to see Japan no longer as, a tactical bet, but more a structural one.
And so, Michael, if I can bring you back as well. Long-term investors, unconvinced that this time is different for Japan, might point to a fiscal house that's on order with eye-popping debt-to-GDP numbers of 280%, although it probably needs to be pointed out that the Bank of Japan holds most of this debt and interest rates are still very low compared to other developed markets, because the thing about that I've come to realize about managing debt is not the size of the debt, but the interest payment that you have to make. As long as interest rates are low, you can sustain 280% debt to GDP, right? But still, it's debt levels that are absolutely enormous. Now, some have suggested that Japan has fallen behind in key sectors related to AI and cutting-edge tech development and the like. How would you address fears that we might see more of the same from Japan over the next year? So let's say what Anneliese now explained in terms of structural advantages, potential win at the back of Japan. I mean, anyone that says no, Japan more of the same. I mean, how would you counter that argument?
Yeah, no, this is a great question, Nico. And I think the reality is what we're seeing today in Japan is not more of the same necessarily. I think we're seeing, just to take the landscape as it exists today, first of all, is we're seeing corporate profit margins at the highest that they've been since the 80s, ultimately. Right? We're seeing renewed interest in investing in Japan. I think the election from yesterday, as you can imagine, we were closely watching this, knowing that the webinar was today, thinking about how this may or may not impact what we say. But clearly, the election from yesterday was a remarkable result in the sense that the scale of the majority that was achieved was one of the marginal cases, perhaps, but perhaps wasn't the base case. But what we do know is that when we have strong, stable majorities in Japan, this tends to be positive when it comes to the level of foreign investment coming in over the next 6 months to a year. Right? This is generally a positive thing that we see. So, of course, today the markets are up. That's a bit of a reaction to the news. I think this is actually a longer-term story where the corporate fundamentals are reasonably solid in Japan. We are seeing more changes, I would say, or more enhancements of the corporate governance regime, which, again, is one of those topics that may not catch everyone's attention. But when it comes to the increased level of buybacks, putting cash to work, these are things that Japanese corporates weren't always doing necessarily. But today we are seeing more and more of it. Ultimately, we've seen the level of buybacks, which is a company buying their own shares ultimately to help support the share price and boost earnings per share, have increased over 2x over the last 2 years. So that's remarkable. So this sense of, is it just like last time in Japan? I think we're seeing clearly signs that things are changing. And now, of course, to your question, what about AI? Has Japan missed the boat when it comes to AI spending? Ultimately, I think the answer is no. I think this is an economy that is actually well positioned to benefit specifically from what we call physical AI. So physical AI, which is the combination of AI models with robots or vehicles or other physical objects. I think ultimately Japan is a society that is very well positioned to benefit from this. We see about 25% of the market is industrial, so it's already a highly industrialized economy in many ways. But also, of course, well known is that by 2040, we're looking at meaningful labor shortages potentially in Japan, and how can further automation actually start to address some of those concerns. So the ingredients exist, in my mind, for Japan to be a real user of physical AI. And the good news, I think, is that it's not just me thinking this. Ultimately, we've seen reports, we've seen news from a number of organizations such as the OECD writing reports on the opportunity for Japan when it comes to physical AI. And last but not least, the Prime Minister is now a huge supporter of physical AI and has put in a 1 trillion yen package to promote public-private partnerships around physical AI. And finally, this isn't just, I know when we talk about AI, sometimes the view is, is this something that's coming now in a few years? The actual impact from a efficiency perspective might be down the line. No, we're already seeing this. There's been surveys already of the industrial base within Japan, and we know that those firms who have already started to adapt new levels of physical AI and automation in their businesses have seen to date at least a 9% increase in efficiency versus the base case where they haven't. So I think ultimately we are seeing this come through, and I think a supportive political environment, as we've seen from the results yesterday of the election, will only help to further promote Japan as a target for more investment, as I say, but ultimately for more use cases when it comes to physical AI, increased automation, increased ability to leverage efficiency to the best way that they can.
Fascinating. You heard it here first. Physical AI is a thing, ladies and gentlemen. It's a theme that I'm not too aware of until now, but it makes a lot of sense, right? And I think of late, software companies have been under a lot of pressure, specifically with new technologies potentially completely disrupting a lot of these large software companies, their business model. When it comes to physical AI, it's a really interesting point that you make. And I would think Japan is quite well positioned there, having a strong automotive industry, very large emphasis on production, making physical things, but also high technology physical things. And so in that space, it does seem like, they don't have many challenges in that space. And also just to your point on elections, so that's Prime Minister Takaichi that won a supermajority in snap elections yesterday, right? So very interesting developments, certainly. And you made the point, and I want to echo that point, is stability is absolutely key, not just in Japan, but in any economy, right? And I mentioned at the top of the webinar, the concern that businesses have when they think long-term, even not long-term, 2 years, 5 years, what U.S. policies are going to be, how AI will disrupt investment potential in companies. And when you want to build manufacturing capacity, you have to have a long-term view. And so potentially with Japan now having more stability when it comes to their policies, that is a very good thing, a good harbinger for the economy. If you have any specific examples that you can think of, maybe just in terms of how policies in Japan have favored certain industries or companies, maybe share that with us, or just how the stability in this government particularly can actually be a positive thing for Japan.
I think just to jump in quickly on that point, Nico, because I think that one thing we haven't actually mentioned yet when it comes to stability in Japan is clearly the relationship with the U.S., which is very important when it comes to the Japanese industrial base. And one area where stability is clearly a positive is around the tariff and trading arrangements that we've seen now put in place. So what we've had so far is an agreement between Japan and the U.S. around the tariff regime, and it involves some investment from Japanese industry into the U.S. economy, again, around these areas where Japanese industrials are strong. So whether that's around manufacturing, industrial automation, of course, infrastructure investment and the grid, these are key areas that we expect to see come through. And also the plan is kind of rolling out now over the next few months. So this stability is absolutely critical. As you say, I think this is what's really been driving and hopefully will continue to drive when it comes to the Japanese equity market perspective, that uptick and that interest, and ultimately that investable landscape from investors around the world, I should say, not just domestic investors as well. So to me, I think you've absolutely nailed the point. It's a critical part, and clearly we couldn't have known before this discussion around the results of the election, but that has been a hugely positive one when it comes to the equity market's response this morning.
It would have been awkward if the election was tied up, or there's more uncertainty for Japan.
You're right.
The timing is great. Michael and Elisa, I want to thank you for now. We might return to you a bit later if there's time for questions and answers, but I'm pretty sure everyone attending this webinar will just attest to the fact that you've given us wonderful insights into Europe and Japan. I want to invite our third speaker, Sia, to the proverbial stage. So, Sia, our speakers have sketched a really interesting picture as relates to European and Japanese stock attractiveness and economic stability and the like. Despite high levels of uncertainty in global equity markets more broadly, can you maybe provide our listeners with a brief overview of the two feeder ETF strategies that Satrix is bringing to market and what they can expect to buy when they invest in these feeder ETFs?
Sure, thanks, Nico, and hello to everyone watching and listening. Indeed, some great insights from Michael and Annalisa really reflect some of the opportunities and views that we want to bring to our market and our clients. And without them moving too many parts and having to actually access these regions in a very steep and costly way. Certainly, the picture painted by Michael on how he highlighted the sectors in Europe, the catalysts to actually watch, and all these pull factors and flows seen going to these areas. And Annalisa's point on Japan's structural transformation makes me even more excited about us launching these two ETFs. I love the point about Japan and physical AI. That's a great point. US has definitely led the boom on AI software. Japan has been very important on the physical part as well, and also just the industrial part with this entire revolution. I mean, I'm sitting here thinking that those guys in Japan will apologize for just being late by 2 seconds on their bullet trains. So that's really where the physical AI comes in and just managing those big networks of those bullet trains there. So yes, going back to your question, Nico, so Satrix is indeed launching two feeder ETFs in this space. So the Satrix MSCI Japan feeder ETF and the Satrix Stoxx Europe 600 feeder ETF as well. All will be localized. It will be locally listed on the JSE, and also they will be rand denominated. So when we list and manage these ETFs, instead of trying to fully replicate the two indices, we'll be using established offshore UCITS ETFs as the underlying portfolio. So in this instance, the Amundi Core Stoxx Euro 600 UCITS ETF. And then on the Japan side, we have the Amundi Core MSCI Japan UCITS ETFs as the underlying portfolios. The locally listed Satrix ETFs will be structured as feeder ETFs. So Nico, this then allows us to actually list the ETF on the JSE for investors to buy and sell in rands, and all the flows will trickle down to the Amundi underlying funds, which are the ones who actually hold the actual basket of shares that replicate the indices. The benefit here, of course, is that comes with at the end of this is that, of course, it's our clients and consumers who are really taking the advantage at the end of the product here. There are several cost benefits in such a feeder structure, which I think for these two ETFs would be so it will be structured as feeder. So the benefits would be that I can mention would be offshore scale and liquidity advantage. So these underlying Amundi ETFs are large, very liquid, and are highly traded offshore in different exchanges. So the benefit there is economies of scale with the underlying ETFs spreading costs across a huge pool of assets. And the Satrix feeder ETFs then inherits the cost efficiency. And that trickles down to what the end client experiences in terms of the maximum TER on these ETFs. Since Satrix will be feeding into these existing ETFs, we don't need to try and build and maintain and replicate an offshore portfolio onshore. We don't also need to manage cross-border settlements and large trading operations in multiple markets. So this really helps in reducing any operational overheads by keeping admin and ops costs down for our clients. All what I've said, Nico, is evident in the maximum TERs that we are offering to clients for these two ETFs. If you look at any JSE listed ETFs that are actually tracking the similar indices, you'll find that the costs are quite high, almost 1% TER. But with our funds, the Satrix Stoxx Europe 600 ETF will have a maximum TER of 25 basis points, while our MSCI Japan ETF will be priced at 35 basis points maximum TER. So for long-term investors using these funds as offshore building blocks, these lower ongoing costs can make a meaningful difference to compounded returns over the long term. But Nico, apart from the cost, I mean, there's quite a lot of convenience for our clients when it comes to bringing such strategies to market. The challenge for Satrix when it comes to the concept of localizing global ideas is that our client is getting sophisticated on one end, and at the same time, consultants also are asking hard questions about what exactly drives returns. And we simply cannot go to clients and consultants and shout diversification every single day. So when looking at global exposure, looking at just the MSCI World with US geographical exposure of about 70% or so, there's a natural gap to actually fill that for clients who still want global exposure, but with other regions elevated as well. But that elevation, very important, that elevation needs to make sense. So in other words, why would clients want more exposure into these regions outside the argument of just diversifying away from the US? And I think this is where these two regional ETFs play a big and very important role in portfolio construction.
Yeah, some great insights there, and I do see the questions are coming in thick and fast, and we'll try to address them as we go along. And I think Sia might allude to some of these points in his answers. But Sia, I think listeners may question why. So I want to get to the specifics in a second, but listeners may actually question why Satrix would be bringing more strategies to the market, considering we already have European and Japanese equity market exposure in our MSCI World Tracker Fund. Can you maybe distinguish for us and break it down? I know you mentioned it, but maybe just for completeness, fully expand on that. Distinguish between core and specialist strategies in the context of what we offered, what we bring to the market, and specifically highlight why adding more granular choice. So these regional ETFs that you mentioned will ultimately help our investors build more sophisticated portfolios at a low cost. And I just want to stress again, you mentioned 35 basis points, 25. That is 0.35%, 0.25%. I mean, these are incredibly low cost building blocks. So why bring this to market for investors?
Yeah, so great question, Nico. Thanks. I mean, if you wake me up and straight from my deep sleep, I mean, and you ask me this question, I would certainly want to mention that Satrix is not looking to launch storytelling ETFs or just another global exposure ETF. But what we are doing right now for our clients is to actually introduce more portfolio role clarity products. So in other words, these are not hot themes, but they have an important role to play in prudent portfolio construction with clients looking for building blocks that have a role to play in their long-term investments. So core global equity ETFs, such as those tracking the MSCI World Index, as you've mentioned, have become the foundation of offshore investing for many South African investors, also outside South Africa. So seen as a one-stop shop solution for access to developed markets and providing diversification across countries and sectors and currencies, right? But over time, however, the role and composition of these core indices has really evolved significantly. So understanding this evolution is key for anyone listening and watching this webinar, and they will appreciate why specialist indices like the Stoxx Euro 600 and the MSCI Japan Index can play such an important complementary role in portfolios. So the MSCI World Index was historically designed to represent a balanced basket of developed economies, the US, the Europe, Japan, and other major markets. And decades ago, it offered a relatively even spread across these regions, more so in other regions as well. But the index is market cap weighted, and as we all know, the US equity market has outperformed and grown larger, driven by the rise of mega cap technology and platform companies. So this has made the MSCI World become increasingly dominated by the United States-based companies, around 70% of the index. Granted, that these US-based companies are actually massive multinational companies who pull their revenues across the globe. But the concentration risk there is still that these indices are mostly skewed to US policy exposure. So since those companies are actually based in the US. Really, Nico, my point here is that the MSCI World remains as an excellent core index, but it may no longer be a neutral representation of the developed world. So exposure to other major developed economies such as the Europe, the UK, the Japan areas has become relatively small in these core indices. I mean, Japan is almost 5% of the MSCI World, while it's the third biggest stock exchange behind the New York Stock Exchange and the NASDAQ. So despite these regions representing some of the largest economies in the world, with distinct industries, sometimes different policy cycles and also corporate structures, their representation in core indices has become very small. So this is where specialist regional products like the 2 ETFs that we're launching actually play a role. But very important, Nico, these indices are not designed to replace the core global allocation for clients, but rather to actually complete the global picture for clients. So instead of replacing the core indices, rather clients think of these specialist indices as complements. And that is the strategic intent for Satrix when it comes to launching these products. We are introducing these building blocks to actually for our clients with very competitive fees to complete the global picture, which allow investors to actually diversify into these regions. So maybe just to finish my point, Nico, the launch of the Satrix MSCI Japan and the Satrix Stoxx Europe 600 ETF fits naturally into the evolution of modern portfolio construction, where global indices remain the foundation, but the specialist regional exposures are actually increasingly essential complements, helping investors build more balanced, resilient, and truly global equity portfolios.
Can't agree more with you there. And you know, Sia, 10 years ago, if someone said, well, the rand is strong and you need to take some money offshore, well, the answer was simple. You put that in dollars, you park that in a US equity market or tracker, and you're off to the races, right? Well, today things are a bit more uncertain. The dollar is on the back foot, and you heard earlier Annalisa make a good case for why there might be further pressure on the dollar. So having European equity exposure, or Euro exposure, or Japanese exposure simply helps you diversify a bit more fully. And the simple case of just moving, having some offshore exposure is more nuanced today. And so I like the point that you make in terms of having your core strategies, your MSCI worlds, well diversified. But also within that, it's important to note that you made the point, Japan is 5% of that. That's bizarre. It's the third largest economy in the world, one of the largest market cap by market cap of their stock exchange, and yet you only have 5%. And so having the ability to actually tweak those numbers, I think is an incredibly important thing for clients. But see, I just want to talk about product-specific thing, and some might also, and I see in the question, some are asking, why Satrix would be bringing to market strategies that already exist in the local market. So there's already, European and Japanese index, sorry. Can you maybe give us a quick breakdown of how the new Satrix ETFs differ from what is already available in our local market, and whether the cost differences also are material?
Sure. So there are local providers, correct, who have products in the space listed on the JSE, as mentioned already. But I think with our ETFs, there's quite a huge cut in cost benefits for clients. But also on the European side, we are tracking one of the most diversified developed market indices globally, the Stoxx Europe 600, with around 600 counters. From the name, you can actually see that, from large to small caps, which investors will get exposure to 17 European countries, including the UK. Very important that I mentioned that part. So this index offers a different set of industries, a different economic engine, as you would have seen or heard from our speakers previously, and a different return profile as well to what is out there. So UK is about 20% of the index. So investors also get an opportunity to actually get exposure in international banks, energy majors, and many UK firms also earning revenues globally as well, which will feed into this index. But something that I also like about this index is that there's also a currency diversification within the index because of the areas that you get from the index. So about 60% in the euro currency exposure, 20% from the pound currency. But then there's other currencies like the Swiss franc and Swedish krona and so on. So different layers of diversification for clients. And so the major differentiation on our Euro ETF is really the spread into these different regions and long list of counters that truly represent the region instead of focusing mainly. And I got this question online as well, like why are you not focusing on this blue chip? And that's the main reason in terms of just spreading the risk across and also representing the area very well instead of just focusing mainly on blue chip, large stock, Eurozone stocks, which can be rather volatile and quite expensive for clients. And also something clients will see in the return of the fund is that our Satrix Stoxx Euro 600 ETF is that there is also a benefit from favorable withholding tax rates thanks to it being domiciled in Luxembourg compared to the tax rates applied to the replicated index. This will trickle down into what the end investor gets from our feeder ETF or for this index. And then on the Japan side, really it's the replication and underlying structure that gives us the edge in the local market, which has given us the opportunity to launch the Satrix MSCI Japan ETF at a fraction of what you see out there in terms of TERs. Again, because of the size of the underlying Amundi ETF or tracking this region, we will tend to deliver accurate and very tight tracking for the MSCI Japan Net Total Return Index. That is the ETF will be managed against. And lastly, Nico, these two ETFs accumulate dividends, so investors will automatically benefit from total returns compounded as their dividends will be reinvested and a big advantage in terms of long-term growth for our clients. And I just need to mention this, but the two ETFs will officially launch on the 19th of February. So we're currently running IPOs at the moment, which will close on the 12th of February. So our clients can access the IPOs on their direct investment accounts, but we'll only get access to them on their tax-free savings accounts once the ETFs launch.
To ask you that because there's two questions in the Q&A. Why you can't access it through your TFSA account, i.e. participate in the IPO on your TFSA account. That's because it's not yet listed. Once it is listed, you'll be able to access that. And then maybe see if we can just also, I see another question is asking, what is the difference between an equity tracker fund and an equity feeder fund? So maybe just very briefly explain when you see feeder in the name, why you are seeing that, why we're not tracking that directly. And then maybe just a quick explanation as well for why participating in an IPO makes sense, right? The fact that you don't have any spread costs. So if you can maybe answer those two questions, feeder ETF, what the feeder part means, and then participation in IPO.
Sure. So the feeder structure part will be how I was trying to describe and how we will be tracking these two ETFs. So instead of us actually holding the underlying basket on these two portfolios, will be actually feeding into the Amundi usage. So on the Euros side, we'll be feeding into the Amundi Stoxx Euro 600 UCITS ETF. So there's an underlying portfolio where when flows coming into our ETFs, they actually trickle down to the underlying. So we don't physically hold the shares in there, and that cuts quite a lot of the red tape and also the cost that comes with the tracking of these international funds. So makes it much more easier for investors as well to get exposure into these different areas. So it's quite a big advantage. And also the fact that we're using the Amundi ETFs who have offshore scale and the liquidity advantage as well, that also trickles down to how that feeds into the cost of the fund as well. Whereas on the other side, when you have a tracking portfolio, an actual physical tracking portfolio, you have to buy sometimes, the entire index. And then that comes with quite a lot of admin and also operational side as well which can trickle down into the cost of that as well. And then the question on the last question was about?
The IPO. Just explain the benefit of participating in an IPO.
Sure. Yeah. So the benefit there is that you are pulled into this large pool of investors, and then you'll be allocated your share of the portion when the ETF lists. But what is nice there is that because you were in the IPO at the first start, you will not form part of any brokerage fees that comes with trading the ETFs when you're trading them in a platform. So that automatically is out of your cost when you go into an IPO. And you're first in line in terms of how you receive the exposure with the opening price on the day when the ETF is actually launching. And then the other part is really the spreads that comes with trading these. Remember, these are listed on the JSE. So when you're trading it, the market maker is going to put a spread to it. So when you hold it at IPO, you don't go through that. You get the exposure at the opening price of the day that the portfolio launches. And it's a big advantage, especially for people who are quite conscious of costs. And that is the direction quite a lot of retail and also institutional clients that take when it comes to ETFs, is just the question about costs. And I think there's quite a big advantage that comes with going into the IPO for retail clients when they consider that when they want exposure.
Great points there, Sia, and I just want to echo as well what you said in terms of the feeder structure and the fact that you are now, your fund immediately has scale. It feeds into a very liquid offshore ETF directly. So you get exposure to the underlying, absolutely, without the liquidity concerns you would otherwise have, right? So because it feeds into this large, liquidly traded ETF managed by the premier index tracker in Europe, you have all those scale advantages from the onset. So it's an incredibly important point, and also just the cost benefit that investors will share in over the long term certainly makes these two new ETFs incredibly attractive for local investors. So participate in the IPO. It's certainly the message from Sia. If you want to save costs and you want to diversify your global equity exposure, this is a great opportunity. And the IPO closes on the 12th, as you mentioned, Sia. So get in touch with your broker if you're interested, or get in touch with us as well. We are fast running out of time. So I just want to thank all of our speakers. It was a wonderful session. The recording will be made available. So by all means, if you have any further questions, you can direct that to us. But we trust that you enjoyed this session. You learned quite a bit. Sia, I don't know about you, but I definitely learned a lot about Europe and Japan. Also, the physical AI part was really interesting. Got me thinking a lot, because we often talk about software and how it's going to reshape the world. But at the end of the day, someone needs to make a robot or an autonomous car that can actually deliver. And I can think of no better economy to kind of own the physical AI space than Japan. And Europe, just a really interesting proposition from the perspective of industrial development. Europe now weaning themselves off US dependence in terms of and also, Eastern dependence in terms of energy, US dependence in terms of defense. So a lot to catch up for Europe there. And of course, where there's spending, there's going to be the opportunity for returns for investors. And then also financials in Europe looking extremely interesting. And if you compare that to US financials or financials elsewhere in the developed world, certainly makes for a very interesting proposition. And these two feeder ETFs will provide you exposure to those underlying themes, but also just the ability to diversify both geographically as well as from a sector and a theme perspective. Annalisa, Michael, Sia, I want to thank you all for your time, your wonderful insights, and the fact that you've shared your insights so liberally with us. And for those of you at home, thank you for attending. We hope you enjoyed this session, and we will see you in our next installment of IndexMore.